While the financial world was fixated on Bloomberg headlines and geopolitical tensions, something unprecedented occurred in China on February 13th. At precisely 9:49 a.m. local time, the Shenzhen Financial Regulatory Bureau issued a joint announcement that represents a fundamental shift in how precious metals markets operate. This wasn't an isolated regulatory action. 10 government departments, including the People's Bank of China, public security agencies, the Securities Commission, and market supervision authorities, unified behind a single document. The directive was unambiguous. Unlicensed paper gold and silver trading operations must cease immediately, or operators will face criminal prosecution. This marks the first instance of a major global economy deploying criminal law to combat paper precious metals manipulation. The implications extend far beyond China's borders and directly impact every investor holding gold or silver worldwide. Welcome to Geofinance. Today, we're examining a regulatory intervention that may fundamentally alter precious metals price discovery mechanisms globally. To comprehend the significance of China's regulatory intervention, we must first understand the events that precipitated this action. The catalyst occurred in Shuibei, a district in Shenzhen that functions as the operational center of China's precious metals industry. Shuibei hosts thousands of traders, manufacturers, and wholesalers within a concentrated geographic area. This district represents the primary nexus for physical precious metals transactions in China. When industry analysts reference the capital of Asian gold and silver markets, they are describing Shuibei. In late January 2025, this district experienced a systemic collapse that would ultimately trigger nationwide regulatory action. The epicenter was a company called JWR, also known as Jawry Jewelry, which had established one of the largest gold trading platforms in the region. JWR's operation appeared, superficially, to be a legitimate physical gold business. The mechanism was straightforward. Customers would access a mobile application, view real-time gold prices, and execute purchase transactions. The interface was professional, the pricing transparent, and the process seemingly conventional. However, the underlying structure differed fundamentally from physical precious metals trading. Customers were paying deposits as low as 20 yuan per gram to lock in prices, a fraction of actual gold costs. These were not purchases of physical metal. They were leveraged, speculative positions on gold price movements. When prices appreciated, customers could close positions and realize profits. When prices declined, they would lose their deposits. Critically, no physical gold was ever delivered. No actual metal changed hands. The platform marketed this as pre-priced gold trading. In reality, it was an unlicensed futures operation providing 40-to-1 leverage on gold through a mobile application. Initially, the model appeared successful. JWR expanded rapidly, attracting investors throughout China via social media channels. The platform promoted zero processing fees and favorable buyback prices. The marketing was aggressive and capital inflows accelerated as gold prices rose and participants generated paper profits. The system functioned because of a critical assumption. Not everyone would demand settlement simultaneously. This is the foundational principle of fractional reserve systems, whether in banking or precious metals trading. January 2025 proved this assumption incorrect. Gold prices surged and participants simultaneously attempted to liquidate positions. The classic bank run scenario materialized. JWR could not meet redemption demands. The platform implemented withdrawal restrictions. 1 gram of gold or 500 yuan per day, approximately $70 US. Consider the mathematics. Investors with positions worth millions of yuan were limited to $70 daily withdrawals. The disparity between obligations and available liquidity was catastrophic. Investors from provinces across China traveled to Shenzhen. Thousands congregated at JWR's offices. Street protests ensued. Law enforcement intervention became necessary. Physical confrontations occurred. The estimated losses exceed 10 billion yuan, approximately $1.4 billion US. Some estimates suggest more than 150,000 individuals were affected. To contextualize, $1.4 billion evaporated from a single platform, in a single district, in a single city. JWR was not an isolated incident. A second platform, WID7, collapsed immediately thereafter. Same geographic location, identical business model. Investors from additional provinces traveled to Shuibei demanding redemptions. Subsequently, a major silver dealer in the same district defaulted on physical delivery obligations. Over 350 individuals were awaiting silver that would never materialize. Shuibei descended into chaos during the period immediately preceding Chinese New Year, the most significant holiday in Chinese culture. Street protests in a major financial district during Spring Festival represent precisely the scenario government authorities seek to avoid. The regulatory response was swift and comprehensive. The joint announcement from 10 government departments represents an unprecedented coordination of regulatory authority. The document's language is direct and unambiguous, Gold forward pricing, leverage trading, and deferred settlements are now explicitly prohibited when conducted through internet platforms, WeChat groups, mobile applications, or websites. If customers are paying deposits, trading price differences, and closing positions without physical delivery, the operation is classified as criminal activity. This is not regulatory gray area language. This is not a warning about potential future enforcement. Operators engaging in these activities are designated as criminals, not as businesses requiring additional oversight. Understanding this intervention requires recognizing a fundamental structural problem that existed for years. Gold trading in China occupied a regulatory no man's land. Agency jurisdictions overlapped without clear enforcement authority. The Securities Commission could not regulate these operations because they involved claims of physical delivery. Exchange authorities lacked enforcement power because transactions occurred off-platform. 5 or 6 different agencies maintained that oversight fell outside their purview. This regulatory void enabled paper gold platforms to operate without meaningful supervision. That void has now been eliminated. Someone assumed responsibility, and they did not arrive with warnings. They arrived with law enforcement backing. The announcement extends beyond platform operators. Third-party technology companies that develop the mobile applications, trading systems, and infrastructure also face supervision and legal responsibility. China is not merely targeting the dealers. They are targeting the entire ecosystem that enables these operations. Software developers, platform providers, and technology vendors are all now subject to enforcement action. The Shuibei platform's business model is not unique to China. The fundamental mechanism, selling paper gold and silver to customers who believe they are purchasing physical metal, settling on price differences without delivering actual metal, using leverage to amplify speculative positions, and creating the illusion of supply that does not exist, this occurs in Western markets daily. Paper contracts trade in volumes that dramatically exceed available physical metal. The price displayed when investors check silver or gold is not determined by physical metal availability. It is determined by the volume of paper contracts created and traded by institutions with sufficient capital to influence market dynamics. When silver prices increased rapidly, the Chicago Mercantile Exchange raised margin requirements repeatedly. Each increase forced leverage long positions to liquidate. Prices declined, providing relief to institutions holding short positions. The exchanges did not protect retail traders. They protected the institutional participants on the opposite side of trades. This is not speculation. This is documented in margin requirement changes and their correlation with price movements. China examined this dynamic occurring within its borders and classified it as illegal fraud, subject to criminal prosecution. The United States has not implemented such measures. The United Kingdom has not implemented such measures. The COMEX operates using the same mechanisms it has employed for decades. The same financial institutions that paid hundreds of millions in fines for precious metals manipulation remain active market participants. There has been no 10-department joint order, no criminal prosecution threats, no emergency announcements. We must acknowledge that China's intervention was not motivated by principles of market fairness. They acted because the JWR collapse created a crisis involving protests, political embarrassment, and financial instability. This was necessity, not principle. However, consequences are indifferent to intentions. Whether China banned paper trading to protect investors or preserve political stability, the result is identical. The world's second-largest economy has classified gold and silver trading without physical delivery as criminal activity. Consider the implications for demand dynamics. Chinese investors who previously speculated on gold through paper platforms now face 2 options: cease precious metals, investment entirely, or purchase physical metal, actual gold and silver that must be held and delivered. The paper alternative has been criminalized. There is no third option. When speculative energy is forced into physical buying, metal must be sourced. It must be mined, refined, shipped, and delivered. It cannot be created digitally. It cannot be settled in cash while maintaining the fiction of existence. This represents the fundamental distinction between China's action and Western market operations. In China, selling gold or silver you do not possess is now a criminal offense. In Western markets, selling gold or silver you do not possess is a standard business practice. The announcement provides companies with a transition period before Spring Festival to adjust operations. The language is explicit. If businesses return after the holiday without modifying their operations, regulatory enforcement will proceed. This is not guidance. This is not a suggestion. This is a deadline with criminal prosecution attached. The document specifically references 2015 and 2016 when the State Council conducted similar cleanup operations of trading venues. Individuals were arrested directly, without warnings or grace periods. The reference to prior enforcement serves as a reminder to the industry. The government is establishing that this is not rhetorical positioning. This is actionable policy with precedent. Several critical questions emerge as we approach the post-Spring Festival period. Will other Chinese cities implement similar regulations? Will Beijing issue a national directive? Most significantly, will speculative capital that previously flowed into paper platforms redirect toward physical metal purchases? If capital flows shift to physical demand, the physical metals market will experience significant tightening. Current market participants are not prepared for this scenario. This development transcends Chinese domestic policy. It affects every precious metals investor globally and the price of every ounce of silver and gold. For decades, precious metals price discovery has been controlled by Western paper markets. London and New York established prices. Global markets followed. Physical premiums in Shanghai, Mumbai, Dubai, and Tokyo were classified as local anomalies, noise rather than signal. What occurs when the world's largest physical buyer classifies paper price discovery as fraud? What occurs when they prohibit it? What occurs when they mandate physical settlement exclusively? The result is price bifurcation, a paper price established in New York and a physical price established in Shanghai. Over time, the physical price becomes determinative because it is backed by actual metal. The paper price is backed by contractual promises. We have observed what happens when paper promises cannot be honored. $1.4 billion in losses and 150,000 individuals with unredeemable positions. This is not theoretical. It is currently occurring. Shanghai and COMEX have displayed divergent silver prices for months. Physical premiums in Asia have consistently exceeded Western paper prices. Dealers in China, India, Japan, and the United Arab Emirates quote physical metal at prices above screen prices. Two different prices for identical metal, two different realities. China's action makes this divergence permanent by mandating that only physical transactions are legitimate. The Shenzhen announcement transcends local regulation. It is a philosophical declaration. It states explicitly, we do not trust paper precious metals markets, we do not trust prices unsupported by delivery, and we will employ criminal law to enforce this position. No Western regulator has made this statement. No Western exchange has moved in this direction. Until they do, two precious metals markets will operate under fundamentally different regulatory frameworks, one where paper contracts dominate, and one where physical metal is legally mandated. For investors holding physical gold or silver, this represents validation, not because China supports their position, but because the largest physical market globally has acknowledged what physical holders have asserted for years. Paper is not real, unbacked contracts are not real, and leverage without delivery is not real. In China, these are no longer merely incorrect practices, they are criminal offenses. To fully comprehend the significance of this development, we must examine the structural mechanics of precious metals markets. Western precious metals markets operate on a fractional reserve principle similar to banking. Multiple claims exist on the same physical metal. This functions adequately under normal conditions when redemption demands are distributed over time. The system becomes unstable when simultaneous redemption requests occur. This is precisely what occurred in Shuibei. This is precisely what occurs during bank runs. The mathematics of fractional reserve systems are straightforward. When obligations exceed available assets and liquidity demands concentrate temporally, the system fails. The Shuibei platforms offered 40-to-1 leverage. This means for every ounce of gold that actually existed, 40 claims were created. When prices moved favorably, this generated substantial paper profits. When prices moved adversely, or when liquidation demands concentrated, the system lacked sufficient underlying assets to honor claims. This is not unique to Chinese platforms. Western precious metals. Futures markets operate with similar leverage ratios. The difference is regulatory treatment. Western regulators classify this as normal market function. Chinese regulators now classify it as criminal fraud. When paper contracts trade at volumes exceeding physical supply, price discovery becomes detached from physical market fundamentals. Prices reflect paper contract trading activity rather than actual metal availability. This creates a paradox. Prices can decline while physical premiums increase, indicating that paper and physical markets are providing contradictory signals. Historically, Western paper prices have been treated as authoritative. Physical premiums have been dismissed as local inefficiencies. China's regulatory action reverses this hierarchy. They have declared that physical is authoritative and paper is fraudulent. If price divergence between physical and paper markets persists and expands, arbitrage opportunities emerge. Traders could theoretically purchase paper contracts at lower prices and simultaneously sell physical metal at higher prices. However, this arbitrage is constrained by physical delivery limitations. If paper contracts cannot be converted to physical metal efficiently, the arbitrage breaks down. This is precisely the scenario that occurred in Shuibei. Paper profits could not be converted to physical metal because the metal did not exist. China's action is not without historical precedent, both within China and in global financial markets. The announcement specifically references state council actions in 2015 and 2016 targeting trading venues. Those enforcement actions resulted in direct arrests without preliminary warnings. The reference serves multiple purposes. It demonstrates precedent, establishes credibility, and functions as a warning to current operators. In 1980, the Hunt brothers attempted to corner the silver market by accumulating physical metal and futures contracts. When COMEX changed margin requirements and implemented position limits, the Hunt brothers' positions collapsed, resulting in substantial losses. The regulatory response then, as now, involved exchange rule changes that protected institutional participants. The difference is that China is now prohibiting the paper mechanism itself rather than merely adjusting margin requirements. The London Gold Pool was an agreement among central banks to maintain gold prices by coordinating gold sales. The pool collapsed in 1968 when redemption demands exceeded available gold, leading to the establishment of a two-tier gold pricing system. This historical episode demonstrates that when paper claims exceed physical availability, the system bifurcates into separate markets with different prices. In March 2022, the London Metal Exchange suspended nickel trading and canceled trades after prices surged due to a short squeeze. The exchange intervened to protect a major market participant facing catastrophic losses. This incident demonstrates that when paper positions face delivery obligations they cannot meet, exchanges intervene to protect institutional participants, often at the expense of retail traders who held correct positions. China's approach differs fundamentally. Rather than intervening to protect paper market participants, they are criminalizing the paper market structure itself. Several scenarios emerge from China's regulatory intervention, each with distinct implications for global precious metals markets. Scenario 1. National implementation. If Beijing extends Shenzhen's regulations nationwide, China's entire precious metals market transitions to physical-only trading. This would redirect all speculative activity toward physical purchasing, creating sustained demand for actual metal. The supply chain implications are significant. Increased physical demand requires expanded mining production, refining capacity, and logistics infrastructure. These cannot scale instantaneously. The result would be sustained physical premiums in Chinese markets, creating persistent price divergence from Western paper markets. Scenario 2. Limited geographic scope. If enforcement remains limited to Shenzhen or specific cities, capital flows may shift geographically rather than structurally. Speculative activity could migrate to jurisdictions with continued regulatory tolerance for paper trading. However, even limited implementation creates precedent. Other jurisdictions observing China's actions may conclude that paper precious metals trading represents financial stability risk and implement similar restrictions. Scenario 3. International regulatory convergence. Other nations may examine China's approach and adopt similar frameworks. If major physical markets like India, UAE, or Southeast Asian nations implement comparable restrictions, the global precious metals market bifurcates into two distinct systems: paper-based Western markets and physical-only Asian markets. This bifurcation would fundamentally alter price discovery mechanisms, with physical markets potentially establishing premium pricing that Western paper markets cannot suppress through contract creation. Scenario 4. Western paper market response. Western exchanges may respond by tightening delivery mechanisms or increasing physical backing requirements for paper contracts. This would reduce leverage availability and decrease paper contract volumes, bringing paper prices closer to physical market fundamentals. Alternatively, Western exchanges may maintain current structures, accepting that their prices represent paper market dynamics rather than physical market realities. In this scenario, two distinct price benchmarks emerge globally. Regardless of which scenario materializes, any meaningful shift toward physical demand creates supply constraints. Mining production cannot increase rapidly. Refining capacity is finite. Logistics infrastructure has throughput limitations. If even a modest percentage of Chinese speculative capital previously invested in paper platforms redirects to physical purchasing, global physical markets face unprecedented demand pressure. For investors, China's regulatory action presents several considerations across different timeframes and asset allocation strategies. Investors holding physical gold and silver receive validation that their allocation strategy aligns with the direction of the world's largest physical precious metals market. China has explicitly stated that unbacked paper claims are unacceptable, and that physical possession is the only legitimate form of precious metals ownership. This does not guarantee price appreciation in the short term, as Western paper markets continue to influence price discovery. However, it establishes that the largest physical buyer globally is mandating physical-only participation, which creates structural support for physical demand. Investors holding paper positions in Western markets should recognize that regulatory divergence creates basis risk. The price of paper contracts may diverge from physical metal values, particularly if Chinese regulatory actions accelerate the existing trend of physical premiums in Asian markets. Paper positions remain valid in Western markets under current regulatory frameworks, but the risk that these frameworks are perceived as illegitimate by major market participants has increased substantially. The bifurcation of global precious metals markets into physical mandated and paper-tolerant jurisdictions suggests that portfolio allocation should account for potential price divergence. Investors may consider holding both physical metal and paper positions to capture returns from both market structures. However, if the thesis is that physical prices will ultimately exceed paper prices due to delivery constraints, allocation should favor physical holdings over paper positions. The immediate post-Spring Festival period is critical. Observing whether Chinese companies comply with the new regulations, whether enforcement actions occur, and whether speculative capital flows redirect toward physical purchasing will provide early signals about the durability and impact of this regulatory shift. Market participants should monitor physical premiums in Chinese markets, delivery times for physical metal, and any announcements of additional cities or provinces implementing similar restrictions. China's action highlights counterparty risk in precious metals investments. When paper platforms collapsed in Shuibei, investors discovered that their positions were backed by promises rather than metal. This risk exists in any paper-based precious metals investment where physical delivery is not taken. Investors should assess whether their precious metals exposure is direct ownership of physical metal or contractual claims on metal held by counterparties. The distinction has proven material in Chinese markets and may prove material in Western markets under stress scenarios. Understanding the technical mechanics of how China's regulatory action may transmit through global markets requires examining specific market linkages and transmission mechanisms. Price divergence between Chinese physical markets and Western paper markets creates arbitrage opportunities constrained by physical delivery capabilities. Traders cannot instantaneously transport large quantities of physical metal across borders, particularly given import restrictions, customs procedures, and refining standards. Shanghai Gold Exchange contracts specify Shanghai delivery. COMEX contracts specify New York delivery. Converting one to the other involves significant logistical friction and cost. This friction allows price divergence to persist. Gold and silver prices in China are denominated in yuan. Western prices are typically denominated in dollars. Exchange rate movements affect the magnitude of apparent price divergence between markets. If yuan appreciates against the dollar, Chinese physical prices in yuan may appear elevated relative to dollar-denominated paper prices, even without fundamental changes in physical market dynamics. Investors must adjust for currency movements when assessing price divergence. Different markets specify different purity standards. Shanghai contracts specify 99.99% gold purity. London, good delivery bars specify 99.5% minimum purity. These differences create conversion costs and logistics challenges that prevent perfect arbitrage. Silver faces similar challenges with different bar sizes, purity specifications, and delivery locations, creating friction in cross-market arbitrage. Shanghai Gold Exchange operates on a physical delivery model. Most contracts result in actual metal transfer. COMEX operates primarily on cash settlement. Most contracts close financially without physical delivery. This fundamental structural difference means that increased activity on Shanghai Exchange directly affects physical metal flows, while increased activity on COMEX may occur entirely within the paper market without physical impact. If Chinese regulations redirect capital toward physical purchasing, dealer inventory levels become critical. Dealers in China, Hong Kong, Singapore, and other Asian hubs may experience inventory drawdowns if demand increases substantially. Low dealer inventories create delivery delays and premium expansion, which further incentivizes physical holdings and accelerates the feedback loop between physical scarcity and premium expansion. China's regulatory action occurs within a broader geopolitical context that includes monetary policy, reserve diversification, and international financial architecture. China has been increasing gold reserves for years, consistent with a broader strategy of reducing dollar dependence. Mandating physical-only precious metals trading within domestic markets aligns with this strategy by ensuring that Chinese precious metals demand translates to actual physical accumulation rather than paper claims. Multiple nations are exploring alternatives to dollar-dominated international trade settlement. Gold and silver have historically functioned as alternative settlement mechanisms. China's emphasis on physical precious metals may reflect positioning for a potential future where physical metal plays a larger role in international trade settlement. By criminalizing unlicensed paper precious metals trading, China ensures that speculative activity in these markets occurs through state-controlled exchanges or not at all. This aligns with broader patterns of Chinese financial regulation emphasizing state oversight and control. If China's regulatory approach proves effective in eliminating paper market instability, other nations may adopt similar frameworks. China may be establishing a regulatory standard that influences international precious metals market structure. On February 13, 2025, China implemented what may prove to be the most significant structural intervention in precious metals markets in decades. By classifying unlicensed paper gold and silver trading as criminal activity, China has established that physical delivery is not merely preferred, but legally mandated. This action emerged from crisis, the collapse of paper platforms in Shuibei, that resulted in $1.4 billion in losses and 150,000 affected investors. However, the motivation behind the regulation is less significant than its consequences. The world's second largest economy and largest physical precious metals buyer has explicitly rejected paper-based price discovery mechanisms. They have mandated physical settlement. They have established criminal penalties for violations. This creates a fundamental divergence in global precious metals market structure. Western markets continue operating on paper-dominated mechanisms where leverage and cash settlement are standard. Chinese markets now mandate physical-only participation with criminal enforcement. The implications extend across multiple dimensions. Demand dynamics as speculative capital potentially redirects toward physical purchasing, price discovery as physical and paper markets diverge, supply constraints as physical demand increases faster than production can respond, and regulatory precedent as other nations observe China's approach. For investors, this represents a validation of physical holdings and a warning about paper claims. The distinction between owning metal and owning promises about metal has been made explicit and consequential in the world's largest physical market. The critical observation period is immediately post-Spring Festival. Compliance, enforcement, capital flows, and potential expansion of these regulations to additional jurisdictions will determine whether this represents a localized Chinese regulatory action or the beginning of a fundamental restructuring of global precious metals markets. What remains certain is that the second largest economy has declared that paper precious metals trading without physical backing is fraud. They have established criminal penalties. They have referenced prior enforcement precedent. And they have done so while Western markets continue operating under frameworks that permit and encourage the very activities China has criminalized. Two market structures, two regulatory philosophies, two different definitions of what constitutes legitimate precious metals trading. The question is not whether this matters. The question is how significant the consequences will prove to be. This analysis represents an examination of regulatory developments with profound implications for precious metals markets globally. If you found this analysis valuable, consider subscribing to GeoFinance for continued coverage of international financial developments. The intersection of regulatory policy, market structure, and investment strategy requires ongoing analysis as events develop. We will continue monitoring compliance with China's new regulations, enforcement actions, capital flow shifts, and any expansion of these policies to additional jurisdictions. For comprehensive financial analysis grounded in regulatory and market structure fundamentals, subscribe to GeoFinance.